All right, so in this video, I'm just going to talk briefly about some connections between interest rate bonds and stocks. So let me first kind of start out by talking a little bit about bond grades. So there are lots of bonds that are out there. A lot of companies only have one type of common stock, or one type of stock, common stock. They don't have necessarily a lot of grades. Sometimes there are some companies that have multiple share classes and things like that. But for bonds, we could have a company that has 5-year bonds outstanding, 10-year bonds outstanding, 20 years, 50 years. Some of them could be mortgage bonds where they're backed by certain property. Some of them could possibly have unique provisions where some of them are callable, some of them are puttable, some of them are interest only bonds. Some have variable rates. There are all kinds of different bonds that are out there. So for any given company, they could have a whole slew of different types of bonds. So there are lots of bonds that are out there and with different features and characteristics and so forth. And so to simplify that, ratings agencies came into being, and basically they rate and grade bonds based on their different characteristics. And generally, it is some variation of kind of like a letter grade. So, think of it as, you know, pardon me, more A's the better, and so forth, right? So from that standpoint, if I start getting down into triple B or double B or B or whatever, or some of the different ratings agencies use slightly different ways of doing that, but the basic idea is more A's or A's with pluses or whatever, or the better, and when you get down further down the alphabet, the worse it starts looking. So. Um, for junk bonds, those are bonds that are basically below investment grade. So if I'm using, I think it's Standard and Poor's bond ratings, triple B and above is generally considered to be more or less the investment grade. And if you're getting like below the triple B, then it's like the junk bond status, or sometimes it's called high yield bonds. So that's kind of a euphemistic term for these are junk bonds, sketchier credit quality, not as high likelihood of being repaid, more risk of bankruptcy, etc. So that's the idea behind junk bonds. And so if you think about it, there's less certainty of being paid. They're more unknown. So that starts sounding a little bit more like stock in the sense that stock is not as guaranteed. We don't know for sure what we're going to get out of that either. So in that sense, it's a little bit more stock-like. Um, Although the payments are of course specified and so forth in the bond contract, whereas for stock, for common stock, it's not. So I have a note on here, when are junk bonds acceptable? Well, so junk bonds might be sort of acceptable in the sense of if you're right at that bottom of the economy and the economy starting to improve, if a company has made it through to that point and the economy is showing signs of improvement, well, that might kind of work out. The bond might be okay because we've kind of gotten through the worst of the economic circumstances, and the company still around hasn't gone bankrupt yet. So it might actually be okay. Now I have acceptable in quotes there to kind of note that there's that's not necessarily to say it's always inherently a good idea. It's more of a might be okay. You have to do your research, of course, as always, and engage in your due diligence, etc. Now, when would junk bonds be particularly risky? Well, I would argue that it's probably a particularly bad time to be buying junk bonds when you're somewhere near the top of the economic cycle. So if a company is in junk bond kind of status when the economy has been really good, potentially really good for years, and their credit quality is bad, their credit position is bad, and they're loaded up to the eyeballs with debt, and all those kinds of things that led to bad credit ratings, and that's why they're junk bonds. That's probably not a great type of scenario in which to buy the bonds, possibly. So you're engaging in particularly more risk because those are the companies that are probably going to be in more trouble when the economy slides into a recession. So if you're looking near the bottom, the economy might have actually turned the corner. Maybe it's worth taking a risk there, a calculated risk, possibly, if the company's made it that far. On the other hand, if you're near the top and the companies are still in junk bond, the company's bonds are still in junk bond category, that's not a great sign because the economic situation is only going to deteriorate from there. And that'll probably cause the company's financial position to deteriorate as well in most cases. Now, in general, when I'm looking at what's going on in the stock market as it relates to the business cycle, in a prior video, I showed kind of the ups and downs of the economic cycle and kind of where the bond market and the stock market tend to turn. So the stock market tends to turn before the bond market does, or sorry, before the economy does, and the bond market tends to turn before the stock market does. So let's talk about this. So for the stock market, the reason why the stock market tends to turn a little bit before the economy is based on expectations. So you might hit the stock market might start to drop off the edge and go into declines and be heading towards like a bear market, possibly before the economy has slipped into a recession, basically based on expectations. If the expectations are the economic growth is slowing and inflation is high and the Federal Reserve is raising rates, if all these kinds of things are happening, that can cause the stock market to start to respond negatively, and it may actually fall. But the economy may not have necessarily actually tipped into a recession as yet at that point. So generally, the stock market will kind of tip over into decline, possibly a little bit before the economy does. But the bond market tends to drop before the stock market. And the reason for that is the bond market tends to be driven very much by changes in interest rates. So when the economy is heating up and it's been growing a lot, we have a lot of money chasing goods. Too much money chasing too few goods is inflation. And so when that happens, the Federal Reserve starts to raise those interest rates. And when they raise interest rates to combat the inflation, those interest rates start to filter into the bond market. And as it starts to filter in through the bond market, higher interest rates on bonds cause declines in bond prices, and so the bonds will kind of turn down as a response to the interest rates, and that tends to be before the stock market because the economy could still be growing. Federal Reserve is raising the rates to slow the inflation, perhaps kind of slow the economic growth a little bit to a more sustainable level, and so the stocks could continue to go up due to the ongoing economic growth. The bonds respond to those interest rates a little bit sooner and tend to fall. Then eventually the stock market starts to go down. Then eventually the economy starts to go down and we go into a recession. Now, on kind of the trough side of things, again, generally the stock market's going to start to go up before the economy because of expectations. People start to see glimmers of recovery and improvement. Maybe things aren't getting as bad as much. Things have kind of stabilized. They start seeing glimmers of hope. And so the stock market might start to actually go up, even though the economy hasn't necessarily fully started to recover yet. So the stock market may often start to rise a little bit before the economy does. And bonds will typically start to go up before the stock market because the bonds are responsive very much to interest rates. And when they're in the depths of the recession, generally the Federal Reserve has been lowering rates in order to promote economic growth and try to help the economy. And the lowering of the rates tends to cause the bond market to increase and improve. So generally, that means bonds are going to turn, then stocks are going to turn, then the economy is going to turn typically. So if you see bonds dropping, that's not a great sign. Then if the stock market starts to drop, might make you think it might be headed more towards a peak where maybe the economy is gonna follow at some point there. It's not a guarantee, right? There are ebbs and flows all the way across all of this. But it would be a note of caution that you'd want to kind of start looking at there. But that brings up kind of another little point as it relates to stocks and utilities specifically. So utilities, if you think about them, think like the electric company or something of that nature. Electric companies are very much regulated and they have somewhat more stable cash flows. They're regulated in terms of what their profits can look like, how much they can increase prices and so forth. But they tend to have relatively consistent, relatively stable, relatively predictable cash flows, which starts to sound an awful lot like a bond. So if that's the case, sometimes utilities start to behave a little bit more like a bond than perhaps some other stocks might. And so what I'm kind of nudging towards here is the idea that different stocks will actually respond differently in the business cycle. So even though I've kind of talked about how the stock market as a whole or in aggregate performs, the reality is different segments of the stock market may actually perform differently in different economic environments. And utilities might behave a little bit more bond-like. And so they may hit a bottom before the rest of the stock market does. They may also hit a peak before the stock market as a whole does, basically because they are a little bit more bond-like. All right, hopefully this video has been a little bit helpful. Thank you so much for watching and have a great day.